Materiality in the context of audited financial statements refers to the significance or importance of an item, transaction, or error in the financial statements. It relates to the impact that the omission or misstatement of a particular item could have on the financial statements and the decisions made by users of those financial statements. Materiality is a critical concept in auditing and accounting because it helps auditors and financial statement preparers determine which items or errors are significant enough to warrant attention and disclosure in the financial statements. In this lecture, you will gain a clear understanding of the concept of materiality, its significance in auditing, and its application in the audit process. We will discuss the two main approaches to assessing materiality, quantitative and qualitative factors, and describe how auditors use materiality in audit planning. The concept of materiality is a fundamental principle in accounting, auditing, and financial reporting. It revolves around the idea that financial information should be presented in a way that accurately reflects the economic reality of a business, while also considering the needs of financial statement users and the cost of preparing and auditing the information. Materiality addresses the significance and impact of information on financial statements. In essence, it asks whether a specific item, transaction, or error is large enough or important enough that its omission or misstatement could influence the decision of users who rely on those financial statements. Assessing materiality requires professional judgment by auditors and financial statement preparers. It involves evaluating the specific circumstances and context of the financial statements, considering industry norms and regulatory requirements, and making informed decisions about what information is material. Let's consider an example. Imagine a small retail company with total annual revenue of $100,000. A minor error of $500 in recording one sales transaction would not likely be considered material because it's only 0.5% of total revenues. In this case, the error is immaterial and may not require correction in the financial statements. However, if the same company had a $10,000 error in recording a sales transaction, it would likely be considered material as it represents 10% of total revenue and could impact users' decisions. In this case, the error would need to be corrected in the financial statements. Materiality is a complex concept in auditing because it requires professional judgment to determine what information is significant enough to influence the decisions of financial statement users. Several factors contribute to the complexity of materiality assessments. For example, materiality is assessed from the perspective of a reasonable financial statement user. Different users may have varying information needs and thresholds for what they consider material. This diversity in user perspectives adds complexity to the assessment. Materiality is context sensitive and depends on the specific circumstances of each audit or financial statement. What may be material for one company or industry might not be for another. Professional judgment is needed to evaluate the unique context. Let's consider two companies in the same industry. Company A and Company B, both with $10 million in annual revenue. Company A discovers a $50,000 error in its financial statements, while Company B identifies the same $50,000 error. For Company A, the $50,000 error represents 0.5% of its revenues, which may be considered immaterial. For Company B, the same $50,000 error represents 0.5% of its revenue as well, but it may be deemed material depending on the specific circumstances. If Company B has historically been very profitable and the error affects its ability to meet certain debt covenants, it could be material. In this example, the qualitative threshold, 0.5% of revenue, is the same for both companies, but the qualitative factors, including the financial health of the companies and their relationship with creditors, require professional judgment to determine materiality. Auditors must assess these qualitative factors in the context to make an informed judgment about materiality. This illustrates the complexity and need for professional judgment and materiality assessments. An error or misstatement in financial statements is considered material when its omission or correction could reasonably influence the economic decisions of financial statement users. In other words, an error is material when it has the potential to impact users' assessments of a company's financial position and performance. Let's illustrate with an example. Imagine a publicly traded retail company, XYZ Corporation, with total annual revenue of $10 million. The company's financial statements report a net income of $1 million. However, due to a significant accounting error, the correct net income should have been $800,000. The error of $200,000 in net income is 20% of the reported $1 million net income, which represents 2% of the company's total annual revenue. The error affects the company's profitability and may lead users to perceive the company is more profitable than it actually is. The error may influence the decisions of investors, creditors, and other stakeholders who rely on the financial statements to assess the company's financial health. As a result, the error in this scenario is considered material because it has the potential to reasonably influence the economic decisions of financial statement users. Material errors must be corrected in the financial statements, and if necessary, additional disclosures are made to ensure that users have an accurate understanding of the company's financial position and performance. In auditing, there is a distinction between known misstatements and likely misstatements. These terms refer to different categories of errors or discrepancies identified during the audit process, and they have varying implications for audit procedures and reporting. Known misstatements are errors or discrepancies in the financial statements that the auditor has identified with a high degree of certainty during the audit. These errors are factual and have been confirmed or corroborated through audit procedures. When known misstatements are identified, auditors are required to quantify the aggregate known misstatements. If the aggregate known misstatements are material, they must be corrected in the financial statements. Additionally, the auditor must communicate these known misstatements to management and request that they be corrected. If management refuses to make the corrections, the auditor must consider the impact on their audit opinion and may need to issue a qualified or adverse opinion. Likely misstatements are errors or discrepancies in the financial statements that the auditor suspects or believes exist, but has not yet been able to confirm with a high degree of certainty. These errors are based on audit evidence and professional judgment, but may require further investigation or additional audit procedures for confirmation. When likely misstatements are identified, auditors must perform additional audit procedures to either confirm or refute the existence and magnitude of these misstatements. The nature and extent of these procedures depend on the specific circumstances and the auditor's judgment. For example, during their evaluation, auditors may identify certain estimates that they believe are not reasonable based on their professional judgment and expertise. These estimates may be considered likely misstatements from the perspective of auditors. These likely misstatements could involve overstatements or understatements of assets, liabilities, revenues, or expenses. Auditors are required to communicate their concerns about likely misstatements to management. They should engage in a dialogue to understand management's rationale and to address any differences in judgment. If after discussions and further audit procedures, auditors confirm that the estimates are indeed unreasonable, they will request adjustments to the financial statements to correct the likely misstatements. Likely misstatements in the context of statistical sampling are discrepancies or errors identified within a sample of transactions or items that auditors suspect may also exist in the larger population. These discrepancies are based on observed misstatements in the sample and the auditor's judgment. To confirm or refute the existence and significance of likely misstatements, auditors perform additional audit procedures as necessary. The nature and extent of these additional procedures depend on the specific circumstances and the auditor's judgment. Qualitative materiality involves setting specific monetary thresholds or percentages to assess the significance or materiality of errors, omissions, or discrepancies in the financial statements. These thresholds are used as benchmarks to determine whether a particular item, misstatement, or error is material enough to warrant correction or disclosure in the financial statements. Auditors establish materiality thresholds at the planning stage of the audit or financial reporting process. These thresholds are typically expressed as a percentage of a relevant financial benchmark, such as total revenue, total assets, or net income. Let's say an auditor sets a materiality threshold at 5% of a company's total revenue, which is $10 million. This means that any misstatement exceeding $500,000, 5% of $10 million, would likely be considered material. During the audit, auditors evaluate individual items, transactions, or balances to determine if they exceed the established materiality threshold. If the auditors identified a misstatement of $400,000 in the valuation of a specific asset, they would compare it to the materiality threshold of $500,000 in the previous example. In this case, the misstatement is less than the materiality threshold. If an error or misstatement is found to be below the materiality threshold, it is generally considered immaterial. Immaterial errors may not require correction in the financial statements or additional disclosure. In the example above, since $400,000 misstatement is less than the materiality threshold of $500,000, it may not be considered material, and the auditors may not require it to be corrected or disclosed. Auditors also consider the cumulative effect of multiple immaterial errors or misstatements. Even if individual items are immaterial by themselves, their cumulative impact may become material when considered together. For example, if there are multiple immaterial errors totaling $300,000 in the financial statements, auditors would assess whether the aggregate effect of these errors, when combined, exceeds the materiality threshold. The determination of materiality is not solely based on quantitative thresholds. Professional judgment is applied to consider qualitative factors. If auditors believe that a particular misstatement, though quantitatively below the materiality threshold, could mislead financial statement users, they may still consider it material based on qualitative considerations. This is the concept of qualitative materiality, which complements quantitative materiality. While quantitative materiality focuses on numerical thresholds, qualitative materiality considers the nature and context of errors, omissions, or discrepancies in the financial statements. It recognizes that some items or misstatements may be qualitatively material even if they do not exceed a specific numerical threshold. Qualitative materiality involves assessing the nature and context of items, transactions, or errors in the financial statements. It considers whether a particular item, even if numerically small, could influence the economic decisions of financial statement users. For example, going concern may be considered a qualitative materiality factor. Auditors identify significant uncertainties about the company's ability to continue as a going concern. While these uncertainties may not result in a quantitative materiality threshold breach, they are considered qualitatively material because they could affect users' assessments of the company's long-term viability. Another example relates to high market pressures or intense competition, as it may affect how companies present their financial information to meet investor expectation. For example, consider a publicly traded technology company, Tech Innovators, operating in a highly competitive industry. Over the past few years, Tech Innovators has consistently reported strong revenue growth, and investors have come to expect this growth as a key performance indicator. The company is about to release its quarterly financial statements. However, during the current quarter, Tech Innovators faced unexpected challenges, including supply chain disruptions and increased competition. As a result, the company's revenue for the quarter declined slightly compared to the same period in the previous year. The numerical difference is relatively small, representing a 2% decrease in quarterly revenue. From a quantitative materiality perspective, a 2% decrease in revenue may not breach the established materiality threshold for the auditors. It might not be considered a significant misstatement when compared to the company's overall revenue. However, from a qualitative materiality standpoint, this decrease could be highly significant because of market expectations. Investors and analysts closely follow the company's revenue growth trends. Even a slight deviation from the expected growth trajectory can lead to concerns and affect the company's stock price. The industry is also very competitive, and investors may be quick to react to signs of weakness. A revenue decline could signal that the company's losing ground to competitors. In this example, the qualitative materiality of the revenue decline is high because it has the potential to significantly impact investors' perceptions, stock price, and the company's reputation in a competitive market. Auditors would need to consider the broader implications of this decline and its effect on financial statement users, even though it may not breach quantitative materiality thresholds. As a result, in this example, auditors may need to carefully consider how to communicate this information in the financial statements and accompanying disclosures to ensure that investors have a clear understanding of the company's financial performance and the context in which it operates. Preliminary or planning judgment of materiality and overall performance materiality are concepts used in auditing to determine the significance of errors or misstatements in a company's financial statements. Both are crucial in the audit process, but they serve slightly different purposes and are applied at different stages of the audit. Preliminary judgment of materiality. This assessment is made at the beginning of the audit planning phase. The preliminary judgment of materiality helps auditors set a benchmark or threshold for identifying material misstatements in the financial statements. It is typically a higher level assessment that considers the financial statements as a whole. Auditors take into account various factors such as the company's size, industry, financial health, and regulatory requirements to determine what would be considered material in the context of the specific audit. Materiality is often expressed as a percentage of a financial statement benchmark, such as total assets, total revenue, or net income. Overall performance materiality. This determination is made after the preliminary judgment of materiality, typically during the audit fieldwork phase. Overall performance materiality is used to establish a materiality threshold for individual audit procedures and to guide the audit team's work during testing. It is a more specific assessment applied to individual accounts, transactions, or classes of transactions within the financial statements. Auditors consider the same factors as in the preliminary judgment of materiality, but apply them to specific line items within the financial statements. Performance materiality is often set at a lower level than preliminary materiality, as it is designed to catch small misstatements that could accumulate to a material error in the financial statements. Let's use the accounts receivable account as an example to demonstrate how each of the concepts would be applied. Preliminary materiality. Let's say the auditor determines that materiality for the overall financial statements is 5% of total assets, and that amounts to $500,000 in this example. This is the threshold that represents the maximum amount by which the financial statements can be misstated without being considered materially misstated. In other words, the auditor would use this materiality threshold to assess the overall financial statement's materiality. If the cumulative misstatement in the financial statements is below $500,000, then it would not be considered material. However, if it's $500,000 or more, it would be considered material. Once the auditor establishes the preliminary judgment about materiality, the auditor decides to set the performance materiality. In this example, the auditor sets the performance materiality for accounts receivable at 25% of preliminary materiality, which amounts to $125,000. Performance materiality is applied to individual accounts or classes of transactions and represents the maximum allowable misstatement or tolerable misstatement for those specific areas. When auditing the accounts receivable account, the auditor will consider a misstatement in the accounts receivable account exceeding $125,000 as material and outside the tolerable limit.